Bank of England this week keeps rates steady. Is this the end of the line for UK rate cuts? What does it mean for us as investors? Bank of England basically held the rates at 4%, the lowest levels since February 2023. Interest rates with insurance, borrowing costs and returns on savings were cut back in August to this 4%. Governor Bailey said, "We're not out of the woods yet." The Bank of England governor warns after figures released yesterday put inflation at 3.8% in a year to August, almost double its target. In addition, we just had out today the latest inflation figures from the Global Central Bank, and they're saying the UK will end up at 4.5% inflation within a year. So things are looking pretty grim on that front. Economists are widely expecting interest rates to be held, given that prices are rising at nearly twice the bank's inflation rate. Food prices are the main culprit at the moment. Retailers expect this to hit 6% later this year because households buy groceries regularly. They see inflation week in and week out. They might end up going to the bank and going to their bosses and asking for more money, which I think is very likely indeed. Economist says the MPC is in no rush to cut rates. Before cutting again, the MPC will need to see stronger evidence that pay growth is slowing to a target consistent pace, and that slower pay growth will feed through and lower service inflation therefore. This points to early 2026 before the next rate cut. So interest rates not cut. People say, I hear them all the time and saying this is very high interest rates, and they are quite high in the UK compared to continental Europe, but not when you compare it to the bigger picture. What does this mean for property markets? It'll give you stability and limited relief. A confirmed decision to hold rates means mortgage rates will remain elevated in the near term, so plan if you're borrowing as an expatriate for 5% rates. It's as simple as that. I don't think they'll be cut until February. So if you're on a fixed rate, that could be a bit of an issue. 2 and 5 year fixed deals are likely to remain at 5 to 6% range, with lenders building in cushions against potential rate volatility. Tracker mortgages, be no initial outlook, I don't think, no change. Just stick with what you've got. And variable rates, that is the issue. If you're on a variable rate, how much more will lenders decide they want to put it up by? Just 2 weeks ago, everyone was cutting rates. Now lenders are going to say perhaps they won't cut it again, and we should put ours up. Regional market implications. First-time buyers face a challenging environment, and unless you can get on the Help to Buy ladder and you use one of these government schemes, I think it's going to be very difficult for anyone with house prices at an average of £400,000 to get on the ladder. That's an £80,000 down payment. Remortgaging market, it'll be difficult as well, because if you want to remortgage, your rates are going to be very high, and that's not ideal at all for people who are doing investing. I mean, really, it's a case of proper planning prevents poor performance, and that's really what we should be looking at in all these situations. Planning ahead. Buy-to-let investors, we've got rental yields that are actually going up, so that's a lot easier if you are buying a buy-to-let, because you can put your rent up and it will go up, and despite the fact that there's been warnings of all sorts of rent controls, it hasn't come in, so I don't see it being a problem. Looking ahead, what will happen with lower rates? As I said, capital economics, the Economist expect no further cuts this year and are looking at 4% until February 2026. Key factors that could accelerate rates are clear evidence of sustained disinflation in core services. That's possible. More pronounced labour market weakening. It's running at about 4 million at the moment. Significant economic growth deterioration. I think there's a good chance of that. Reduced global inflationary pressures. Again, if the Ukraine situation does resolve itself, that will tend to reduce global inflationary pressures. But only if it's the right reasons, obviously. High food and energy costs, robust wage settlements, renewed global supply chain disruptions could all delay it further. And it could be late in February, it could be up into June next year before they cut rates. So the overall market outlook for current homeowners, budget for higher refinancing costs. That's not pleasant, so you need to really look at that. For prospective buyers, build it in, add 30% into your costs, because things always cost you a lot more than you expect them to do. For buy-to-let people, rates will increase if you remortgage. If you're buying from the start, rates are 6% or so as an expat, 5% as a UK resident. But from a positive perspective, there's less and less rental property out there, which means that your properties will have more and more of a control of what's going on. So the next rate decision is due on November the 6th, 2025. What will it look like? I don't see it being cut there, because as I said, the G7, of all the G7 countries, the UK is going to have the worst inflation going forward, and that is very grim. You know, it's a bit of a boom-bust scenario, which was what we have with Liz Truss, and the cost of borrowing gets higher because you're a poor risk, which means you have to borrow more money, which means you have to then tax people more. So it's a vicious circle. I mean, the Labour government has inherited an economy where they just spend too much money. It's an old economy that should be rehauled, revised, fixed, major changes. I was speaking to a client today and he was saying, how about, he said his parents get the winter fuel allowance. He said they also get free rides on the buses and they get other sort of benefits like that. His parents are in their 70s. They're comfortable, they've got a good house. They don't need to actually need that money. So what if they were to get involved in a sort of means test, which is what they do with, if you think about it, if you're wealthy and you want to go into a care home, the government assesses how much your house is worth and makes you sell it to pay for it. So why shouldn't you be taking your £1 million house and selling that? Apparently 22% of all millionaires in the UK are pensioners because they're sitting on £1 million house plus, and they're getting money from the state on a monthly basis. So there's a lot of revising of the situation needs to be done, and a general re-look at how it all works. But the Labour government is such a mess that's not going to happen. From a perspective of buying property in the UK, at one point in 2023, there's more than 1 million people coming into the country. It's still running super high, and it's a complete disaster how they're trying to control it. So there's not enough property out there. The target that Labour has set for itself to build new houses is not being hit. They're already 50% below target. They need to change it. So interest rates have stayed at 4%. What does that mean to you? It means if you're a buy-to-let investor, it's still a good buying opportunity. If you're an existing homeowner that pays their own rent, pays their own mortgage and lives in it, that's a bit of a nightmare, to be fair. So I can only sympathise with you. Now we'll just end with a couple of questions from this week. Can anyone guess where I am today? Not that difficult. Okay, that wasn't one of the questions. But as you can see in the background, we're in Dubai. A gentleman called Ian Hogg, 5245. I only want to know when they're going to implement the manifesto they promised us and were elected on. It's never going to happen. Looking from one side of the house to the other, you think I could do that. They've discovered you cannot do it. It's not easy to manage a country, especially when it's old-fashioned, ingrained as we have. Over-engineered says, if Labour implements some or all of the taxes that have been reported, it could be the Margaret Thatcher moment. Goodbye. It will. The poll tax killed Margaret Thatcher. Not literally, of course. It was the end of her reign. And I think the taxes they're talking about bringing in, cutting national insurance payments out and increasing taxes on the way in. Rachel Reeves has got her work cut out, and the Bank of England has not done her any favours by keeping rates the same. In the US, the Fed dropped their rates by 0.25% under pressure from Donald Trump, which is fine if they want to be politically motivated. But in the UK, we have an independent situation. Finally, I'm not reducing my rents on any of my properties. In fact, they're all going up by between 5 and 10% this year. It's from Iman Blesh, and I think that will happen. We're not a social service. We've got to cover costs, but make sure you're giving value for money. Don't be a slum landlord. Don't be a poor landlord. Take care of your clients. That's what it's about. That's it for this week. Thank you very much. I hope the sound is good. This is a new camera. Very exciting. Do take care. Cheerio. Bye.